I know you have views on this, Mark, in terms of our focus on the price hike that we saw, the price jump that we saw around gas yesterday. But really, for you, the central importance of what's happening in Brent as we close into potentially $90 a barrel.
Yeah, absolutely. Oil is a much more important market. There are genuine moves in gas markets. It is an important asset as well. But oil is both more relevant for more industries in real terms and also a much more traded financial instrument. And I think that extra nuance is important because it has P&L implications, it has VAR implications when oil is really moving. But overall, they're both telling the same economic story, and that is that the inflation fight is not over. We may not have vanquished inflation for the long term. We are in a disinflationary period. We do expect that US CPI will continue that theme of disinflation tonight. Even if the headline number will tick up, the core will likely soften, and those readings will imply disinflation just because of base effects. This is the last month, though, that we expect disinflation to be that kind of steady theme. Do we go into a re-inflationary theme from here? I think so. Most people don't. But I certainly, oil and gas price action at the moment supports my view that inflation is again going to be a worry going into the latter part of the third quarter.
OK, interesting. What do you think the sensitivity is of markets now to the CPI print out later today? How big of a surprise would we need to get markets to react to this number?
That's a great question. I wish I'd probably thought about that because it's a really obvious question and I hadn't thought about it in advance. I do think that we're actually going to weirdly worry more a little bit the month-on-month trends at the moment. And I think that people will care about the core. I guess the way I see it is that if we get a beat on a headline, I think people won't get too excited about it. I don't think it will matter. But I think people will be disappointed if the core reading doesn't fall. So the expectations are for headline 3.3% year on year and for the core to be 4.7 year on year. And that's meant to be a lower core. I actually think, ironically enough, that if we get 3.4, 3.5 in the headline, we'll dismiss it as long as core drops. But if we get 4.8 in core, as in the end of that disinflation trend in core, I think people will be more upset about upside yields in that environment. Which way is there the asymmetric risk? I think the real dynamic here is about a steepening of the curve. I think people have bought into the idea that we're near the end of the cycle. But if there's an inflation problem here, it means the curve can still steepen further because we're not going to get into a rapid rate cutting cycle if there's sticky inflation.
OK, we haven't skewered those inflation risks quite yet, is the view from Mark Cudmore. Mark, just briefly on the equities picture, particularly with a focus and a kind of zooming in on the US picture with the S&P, the tech sell-off we saw yesterday. And you're looking at maybe the fact that if you strip out tech, valuations aren't looking as aggressively high and overstretched, maybe, as some might think in the US.
That's completely the case. So US stock market, India stock market are the two really expensive stock markets globally, but really it's tech. Can you disassociate a mega cap tech with the rest of the US stock market? If you do, you see that even the US stock market can be cheap, but tech is very expensive.